Good morning, Bitcoiners. Hello, and welcome back to your Bitcoin Economic Calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledn, and as with every Tuesday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is January 11th, and we have a very special episode for you this week. There's been lots going on in the markets, and we're going to dive into a lot of that today. First off, we're going to look at the CPI inflation data out of the US, which is scheduled to come out this week, and all eyes are on that number. Markets are going to be anxiously waiting because that number is going to feed into some of the actions or future actions or decisions from the Federal Reserve. Second, we're going to talk about the recent moves in the crypto markets, which have led to over $800 million worth of crypto derivatives being liquidated. We're going to discuss how that's been impacting markets and what we can expect going forward. Last but certainly not least, we're going to discuss a piece by Goldman and a few other analysts that are projecting that the Federal Reserve could raise rates up to 4 times next year. So lots to cover. Grab your coffees. It's going to be a great one today. Now, starting as we usually do with Bitcoin, we see that it's been a rough start of the year for Bitcoin, with volatility persisting into the second week of the year, and we've reached a new low essentially so far into the session. It dropped below $40,000 for the first time since September, and this happened yesterday. Actually, Bitcoin dropped around 12%. Below $40,000 for the first time in a really long time. And most major asset classes have been selling off as markets continue to digest the latest meeting minutes from the FOMC. So as a result of some of this recent turbulence in the markets, the headline, or one of the things that we discussed at the start of the issue, was that there's been over 800 million worth of crypto liquidations last week. And these were essentially futures contracts where investors, as we've covered here, take a lot of leverage oftentimes to participate into these long contracts. And as price moves, then these excessive leveraged instruments tend to be the first ones to get liquidated. More so the case, it is the case with Bitcoin, and even more so the case with altcoins, which tend to have even higher volatility than Bitcoin. So this is why, as we've discussed, that when there's a lot of leverage in the system, it can essentially contribute into these very fast, almost cascading liquidations that we can see from time to time. Looking elsewhere into some data from Glassnode last week said that long liquidations dominance hit 69%. This is the graph here. The reference is that this little part here at the very far right. And this means essentially that more than 2/3 of the liquidated trades were people that were long Bitcoin with oftentimes a lot of leverage, which is why the move ended up in their positions having to be closed. As we can see here, the last time we had that many long liquidations or around that level was right around May of last year, after the China mining ban sell-off. And that caused Bitcoin to trade sideways for over 2 months. Bitcoin currently sits at around below 40% off of its all-time highs. And these are levels at which when people have taken on leverage on their Bitcoin, that drop is sufficient to essentially start causing some of those margin calls and liquidations that can tend to spike up volatility in these periods. Another interesting data point that we wanted to share, and this was courtesy of Will Clemente over last week, is that on January 5th, the 1-week implied volatility grinded much higher as liquidations began to increase in some of these leveraged derivatives or derivative platforms like Deribit, for example, or Bybit, for example. They have quite a bit of leveraged future products. And it's interesting to note that even though there was a very significant and meaningful downturn in the Bitcoin market, if we look at the funding rates for perpetual future swaps in Bitcoin, and this is the chart that I'm just about to pop here just a second to show you as reference. So these are the perpetual reps fundings. And just to make it cleaner, we're going to isolate here the Deribit graph so that you can see it. And interestingly, since the start of the year, we can see here that the funding rate for the Deribit's perpetual futures swap never went into negative territory. And if we look at another one like FTX, we see that it very briefly went into negative territory. It's very briefly touched into negative territory. Actually, it went deep into negative territory yesterday when we had that breach into the new low. But this is actually a positive sign, because it means that traders have not essentially started to take on leverage to the downside, which again can be seen as a positive price signal at the current moment. Another interesting signal from the markets was that we saw a lot of put selling over the weekend. Now, this has changed from its composition over the weekend, but when we were down at the 40K mark, we saw a lot of put sells cross the print over the weekend. And these were being sold right around when Bitcoin was trading at around $40,000, which means that the people that are often selling puts, most often than not, are institutions or well-capitalized investors. And if they're selling puts at the 40K level, it typically means that they're selling them for lower strikes, and that makes they're selling them because they would be happy buyers at those lower prices, at the 35 to 30K mark, for instance. Another and again, that is a positive thing for price. Another very interesting thing to show is that even at the current market conditions, the futures curves for Bitcoin still present a very healthy contango outside of Kraken. Kraken's really the only curve that has a forward month price below the current month. All others show a pretty healthy contango, which again, when many investors are expecting Bitcoin to really keep going south, these curves tend to enter into backwardation, meaning the future prices of Bitcoin tend to be priced lower than the current price of Bitcoin. We are not seeing that yet in the markets right now, in the futures curve right now. Lastly, we wanted to check in on a recent correlation between Bitcoin and equities. So as we've been covering here over the last year, Bitcoin started trading in tandem or with a significant correlation with the yield on the 10-year note. As of recently, with the Fed really jacking up the rates and trying to get ahead of inflation, that relationship has started to break somewhat, and Bitcoin has started actually trading more in line with broader markets like the S&P 500. And this is actually a really insightful chart here that shows just how fast the 1 month correlation with Bitcoin and the S&P has spiked higher over the last month. And it is actually not that surprising, because when the Fed starts getting very, very aggressive against inflation, this affects all assets in general, and they start getting very correlated in terms of their price action. We are very much seeing this right now with the S&P 500 and Bitcoin, as Bitcoin is trading more and more akin to the S&P 500. If this remains the same, which again, all markets are going to basically trade in somewhat in tandem based on what the Fed does, we may continue to see some volatility in the crypto markets. And coming, a lot of that could be coming from equities. If the Fed does decide to jack up rates, that's going to really put pressure on equity markets, and Bitcoin is going to have a hard time getting spared from all that pressure. And again, a lot of that might happen when tomorrow's CPI print comes out, because a lot of people are waiting for that. We're going to discuss that in our What's Ahead section today. And the other interesting thing to keep in mind for Bitcoin is to keep an eye on the average purchase price of MicroStrategy, which could act as a psychological support level in Bitcoin prices. And that price is $29,534. That is MicroStrategy's average price per Bitcoin. So based on Mr. Saylor's bullishness and all of his activity to date, it would be not surprising if they were sitting ready to add to their position if it comes close to their average purchase price. Moving over to the S&P 500, we see that equities dropped further into negative territory last week, but they seem to have bounced back so far today. And market participants are essentially bracing themselves or preparing themselves for a potential rate hike in March from the Fed. And this has been accelerated, as many were expecting the first raise to come in the latter half of the year, but now Goldman and others have essentially updated their projections and see the first Fed hike coming in as early as March. And a lot of this was prompted by the release of the minutes that came out last week, the FOMC meeting minutes from the December meeting. So for one, the one that we just covered, Goldman Sachs is essentially now predicting that the Fed will raise rates 4 times this year. And this is, they had previously predicted just 3 rate hikes. As the FOMC meeting minutes came out and many people started kind of digesting the contents and analysts started updating some of their projections, equities suffered and continued to suffer after the release was out in the media. One particular fund that is getting the grunt of it is Cathie Wood's ARK Invest fund, which again tracks a lot of innovation stocks, which would typically sit farther out in the risk curve relative to, say, the average stock in the S&P 500 component. If we look at the ARK Invest performance for the last little bit, we see that this fund actually peaked in February of last year, and it's actually down almost 50% from its peak in the first quarter of last year. The broader sort of sell-off that was caused by last week's the broader sell-off that was essentially caused in the tech sector by the rates and others brought the short interest in ARK Invest as a percentage of outstanding shares to basically 6.86%. And this is according to data from IHS Markit. And so this means that over 6.86% of investors are betting that more pain is coming for this fund, which again is interesting. Along with tech stocks, bonds sold off as well last week. BlackRock's $17.5 billion long-term treasury ETF, TLT, recorded a $1.4 billion outflow, and this is the biggest withdrawal from the fund since March 2020. And we're just going to show here the TLT ETF that we're referring to. Again, we see that it just got absolutely clobbered last week, down 4%, and it triggered the biggest outflows it's seen in a really long time. And in fact, just again, speaking again against bonds in the debt market, the value of the world's negative yielding debt fell below $10 trillion for the first time since early 2020. After having reached 18.5 trillion worldwide. And here is the screenshot that we wanted to share. And again, this is actually positive news in the sense that negative yielding debt is quite toxic. And because of the run up in rates of bonds, some of these real rates have actually gone off of zero. And that has essentially almost halved the amount of negative yielding debt that is available worldwide. So that is very, very interesting. And obviously what this also prompts, while this is all in all generally a positive thing to not have negative yielding debt, what this also means is that the cost of capital is really rising, especially among developed economies. So what this means is that central banks are really working on getting those interest rates higher to try to get ahead of some of that inflation, preventing that from potentially overheating. As we've said, the inflation in the U.S., so going back to the S&P 500 and sort of broader markets, inflation in the U.S. is soaring. We've had the most relaxed sort of monetary policy environment in the last, call it 50 to 75 years in the U.S., and inflation is not really just becoming a U.S. problem, it's becoming a global problem. And as we mentioned, it's forcing a lot of central banks to essentially take action and increase some of those interest rates to prevent their economies from overheating. Real rates in the United States, given where bond rates are or U.S. Treasury yields are and where 6.8 inflation is at, we see that real rate inflations in the U.S. are in the neighborhood of negative 6%, negative 5%. So cash may continue to lose value over the short and medium term because of inflation, even if the Fed raises rates. The gap is just so high right now between what inflation is and what real rates are. And really, the challenge is which one's going to converge, like what's going to force them to converge? Is it going to be inflation coming down, or is it going to be the Fed having to raise rates? And in an ideal world, it's a little bit of both, and they essentially converge in the middle, not pushing the Fed to have to raise so fast, so quickly. Basically, they meet somewhere in the middle. That would be the sort of rosy scenario. Now, the interesting, another chart that we wanted to highlight was this one from Charlie Bilello, which essentially shows where the Fed funds rate has been in the past when unemployment is at 3.9%. And as you can see here, this is the first time in history where unemployment has been so low and the Fed funds rate has been so low. This is probably not going to remain the case for too long, just because historically speaking, this is something that is very uncommon. So all of this, just to kind of wrap it up, there's been quite a bit of converging or conflicting dynamics in the markets right now. There's the fear that the Fed could potentially raise rates too fast, too soon, and kind of bring the markets down before it's time. And there's also the view that the Fed will not ever be able to raise rates, and markets are just going to essentially continue their rosy way up. And so it begs the question, essentially, are investors just having a quick panic that'll be followed by a deep breath and essentially a spot bargain hunt for prices to continue resuming their uptrend? Or are they actually rattled that for the next 12 months, we're going to be in a little bit of sideways market or pain? Well, one of the interesting insights from the best way to answer these questions is to look at how people are positioning themselves. And an interesting data point that came out last week was that billionaire investor Bill Miller now actually has 50% of his personal wealth in Bitcoin. So just some food for thought as we get into 2022. Moving over to our analysis of gold, we see that even though last week gold got dropped pretty significantly, 1.82%, so far this week is actually reclaimed that 1,800 mark, and it's trading north of $1,800, $1,814 per ounce at the moment. And inflation and the fears around inflation are working in gold's favor, but as we've covered here in the past, the rising bond rates and bond yields actually work against gold because they make the real return of treasuries more attractive. And so this essentially, it's a bit of a tug of war between inflation and the real return on US treasuries. There was an interesting headline that came out of Reuters last week speaking about just this. Essentially, gold tiptoes on inflation risks despite strength in yields, essentially reinforcing kind of what we said. There's two dynamics that are working in favor and against gold, and right now it's kind of stuck in the middle of those two forces. Gold investors are basically hoping for a sharp drop in inflation that would deter the Fed from tightening or rising rates way too fast. If that, a lot of this might actually be stemmed, the next move in gold might come after the inflation reading that we get this Wednesday, because again, that is going to inform a lot of what the Fed is going to be potentially doing. Another kind of force that's been playing against gold, and this again ties back into the better real returns of the US dollar, is the fact that the US dollar index has strengthened quite a bit over the last little bit. It still kind of remains. We've seen actually some stability actually over the last 2 to 3 weeks in this sort of 95 range. But again, as real rates rise, that makes the dollar more attractive. Real returns on the dollar become more attractive, and it basically pulls people away from gold. Zooming out and looking at the gold 20-year chart, which was courtesy of Charlie Bilello, and we're going to put that here. The a couple of interesting things to note here is that the S&P 500, the gold's 20-year return is around 550%, which is very close to Berkshire Hathaway's stock, which traded essentially close to all-time highs last week. Another reason that essentially is it just shows us that it really depends on the time frame that you're looking at. But gold actually over the last 20 years has done really well relative to other assets that are in more of the limelight, like Berkshire Hathaway stock. which is actually interesting. So a couple of things playing for and against gold. We'll continue to monitor these dynamics. Moving over to our DeFi analysis, we've seen that it's been a rough start of the year for the DeFi index too. Last week it dropped 17%. This week it continued dropping, but it has so far resumed or seemed to have been found some bids or some buyers, and it's essentially trading 1.41% higher so far this week. It has, not surprisingly come under pressure the same way Bitcoin and other asset classes have. That was, so last week it was also interesting because in terms of Ethereum, Vitalik was able to provide some updates on the much awaited ETH 2.0 update or transition. And this actually has now been pushed into later in the 2022. So essentially it'll be pushed into the second half of 2022, originally scheduled for the first half of the year. Another interesting thing we wanted to cover is that in one of JP Morgan's latest reports about the DeFi space, the bank mentions that there's increasing competition or an increasingly competitive environment among DeFi protocols as basically chains fight each other on lower fee scaling solutions for smart contracts. And this is the article that we are referencing right now. Now, interestingly, just staying on the topic of the ETH 2.0 transition, the ETH beacon chain, which is a smart contract that is on the ETH network right now, it closed the year at a very high staked value in it. More than $33.5 billion worth of ETH are essentially trapped or staked in this contract. And these are people that are essentially wanting to be validators of ETH2 or ETH 2.0. And to do this, you need to stake 32 ETH tokens into that smart contract, essentially so that you can be a validator when the pending ETH 2.0 upgrade does occur. And then finally, we wanted to share a recent acquisition that has happened in the DeFi space. And this might be a trend that we continue to see more into the year. Last week, we saw WonderFi, which was a Canadian company, bid by another Canadian company, which has essentially as a regulated crypto marketplace. And the deal was done for $162 million in cash and some other stock components. You can see more information on the deal here, but again, this is a trend that we expect to continue into 2022. Moving over to our Bitcoin mining difficulty commentary, we see that the mempool remains pretty clear even despite the recent volatility in price. We see that transaction times and speeds remain pretty optimal right now. And in terms of hash rate, we continue to trend very close to the all-time high 25 terahash mark. The next adjustment is coming in a few days, and it should keep hash rate right around the all-time highs. We'll continue to update you here, but continues to be a good time to transact on-chain. And as always, to wrap it up, we end up with what we can expect for the week ahead. It's been a pretty active, it will be a pretty active week. And as we mentioned at the beginning of the show, the most important piece of economic data that is coming out of the United States this week is the Consumer Price Index, which is released at 1:30 p.m. Eastern on Wednesday. And that number is expected to come in at 7.1% for the month of December. The month of October came in at 6.8%. And it's that 7.1% number that a lot of people are worried about. The Fed and the markets would love to see the number come down below 7%. If the number comes up above 7%, that is going to essentially have the exact opposite impact because it's going to inform the Fed that it needs to act faster or sooner or continue on its plan to move really, really fast. So just to wrap it up, so Wednesday, 1:30 Eastern, we get Consumer Price Index in the US. The big magic number there is 7. A number below will probably be cheered by the markets. A number above will probably result in markets selling off or coming under pressure. Thursday at 1:30 p.m. Eastern, we got two other interesting points of data. The initial jobless claims number, as we mentioned, the Fed does not seem too worried about unemployment right now, but that number is expected to come in around 200,000 initial jobless claims. And the other one that's very interesting is Thursday, 1:30 p.m. Eastern, we get producer price index, and that number is scheduled to come in at 9.8%. So as we've covered here in the past, producer price indexes can many times be seen as leading indicators for consumer price indexes because they just pass on the prices to the consumer. The fact that this is trending higher as CPI is at 7 does not really bode well for future inflation. And so that's why so many people are so focused on this Wednesday's CPI data. So it's going to be a very important week. Likely we're going to see some volatility on Wednesday after the announcement, regardless of the number. So just keep everything in mind that we've said, position yourselves accordingly. If that really wraps up the end of today's show. So thank you once again for being with us. If you enjoyed watching or listening or reading, we welcome you to like the video, share it with your friends, and subscribe to our channel. If you don't yet have a Ledn account, I welcome you to check out Ledn.io and learn how you can start earning up to 6.25% on your Bitcoin, up to 9.5% on our USDC. We have the best rates on US dollar loans if you need liquidity and don't want to sell your Bitcoin. And we just recently announced our Bitcoin mortgage, which will allow you to purchase a home without selling your Satoshis or buy a house as big as your stack. So thank you, everybody. Have a wonderful week and see you next time.